Good morning, good morning. Nice to be in my home province. I feel a little bit that I'm talking to you from on high. Apologies for that, they're recording us. So I have to stand up here, otherwise I'd be running between you and talking to you down there. My name is Melanie Verwoerd, a few familiar faces. Those of you who don't know me, I am just a quick bio. I was a member of parliament in 1994 to 2001 for the ANC. And then I became ambassador to Ireland, then became head of UNICEF in Ireland, and then about 13 years ago I came back and started doing political analysis. I'm one of those who've been around the block quite a long time now. I just want to be clear that I'm not a member of the ANC, haven't been since 2001, so I'm not under any discipline. I call it as I see it. I make them very angry, but often get many angry phone calls from them, but so just understand that I will say it as I see it, and there's no bias as far as I can help it. And then also just another disclaimer, the dress has got nothing to do with the color of the dress, political affiliations. And can I particularly thank you all for being here this morning, because I know you all went to bed really late, gripped by Sona. Couldn't sleep afterwards because you were so excited. Look, a lot of people, my mom phoned this morning and said, like in good old Afrikaans, I've been listening to RSG. Do you know how to respond to the questions around Sona? I'm not going to speak about Sona because there's very little to speak about, right? I mean, we all know it was an election speech largely, Of course, it was going to be a few months before the elections. And so there's very little to talk about, but very happy to talk to you afterwards about it if you have any questions around it, right? I'm going to talk to you about elections. Why? Because in my day-to-day job, I speak to international and local investors every day. And for the last year, I've only been asked 3 questions. If I wanted to talk about anything else, their eyes glazed over. And that is, what's going to happen at the elections in terms of results? Secondly, what does that mean in terms of coalitions afterwards? And thirdly, who's going to be the president of South Africa afterwards? And I'm going to try and answer those questions quite fast. I only have 25 minutes. So if I'm skimming over things too fast, just catch me afterwards. So firstly, let's talk a little bit about logistics and the sort of things behind the scenes. First of all, the date. We, of course, still don't know the date. He didn't announce it last night. We know it has to be before the 6th of August. That's the one thing we know, because they run out of time then constitutionally. They don't like having it in the winter, so the parties are working on the 22nd or the 29th of May, and that's most likely, that seems like a good guess. He has said he will announce it in the next few weeks, so my guess is he will most probably announce it next week, the 15th, when he replies on Sona. They don't like doing it during Sona because it distracts from the exhilarating messages, right? So we don't have the date. It's his prerogative. Only he knows when he's going to announce it and when it is. 42.2 million eligible voters, of which 27.1 million have registered, maybe a little bit more now after this last weekend. So quite a few millions not registered yet, which is a problem. Interestingly enough, 3 million more women voters than men. So unsurprisingly, of course he knows this, the women issue and GBV came up quite high in the speech last night. It was very obvious what he was doing. Gauteng, KZN together makes up almost half of the electorate. And then we have 23,000 just over that polling stations. That's neither here nor there. The IEC is well used to it. That's what they usually have. 2 of the biggest unknown factors that could impact on the election that we won't know until the election is 1, the youth vote. Why is that important? Because as you all know, the demographic bubble sits at the bottom. And I'm going to apologize now in advance because I'm going to use racial terminology when it gets to voting patterns. It's just because our voting patterns are so racially defined still in this country, right? So I sometimes have to say race defined by race to explain it. But why the youth vote, so in terms of the African or black vote, the over 30s, the ANC has basically got loyal voters there, and they've got it sewn up. If you ask people still now, they get very angry with the ANC, but you ask them, but then why are you still voting ANC? They will say, because I was born ANC, I will die ANC. The youth, however, under 30, so that age group under 30, however, is very different. And they tend to swing far more radical, and they tend to swing, it's the ones born post-94, and they tend to swing more towards the EFF. And so if you get a big youth turnout, then you're going to get more EFF votes. And we're starting to see it creep in. The reason why we haven't seen more of it up till now is because the youth have been notoriously bad at registering. So in the local government election, only 4.6 million out of 15 million in the under 30 age group registered. So that's very low. And of that 4.6 million, very few rocked up on the day. And that's why we haven't seen that impact yet, but we will start seeing it more in the future. The youth usually starts getting more interested in politics by the age of 25. Globally, that's the case. It's when they start paying taxes, usually, that people start getting interested in politics. So we're starting to see that post-94 group starting to register a little bit more on the polls. The second issue that can impact and will impact dramatically on the results, and we won't know that until the day of the election, is turnout. Funny enough, a low turnout and a very high turnout benefits the ANC, a medium one doesn't. The low one is a bit complicated to explain. It has to do with the rural-urban bias inside the ANC. I can explain that to you if you want me to, but it takes a bit of time. The other thing is the high turnout. The reason why the ANC did badly in the local government election was not because their voters went and voted somewhere else. They didn't vote. It's the loyalty thing. They remain loyal towards the ANC. They won't vote anywhere else. This is the over 30s, which is still the largest bulk of the voting numbers. And so what they do is that they just stay away. They show their unhappiness in terms of the ANC by staying away. The DA had a totally different problem. The DA did worse in the local government election because people voted either the Afrikaans vote with the Freedom Front Plus, or, I mean, some of them, not all of them, of course, or some then, of course, in Gauteng and a little bit in KZN voted with Action SA. So they've got a different problem than the ANC. The ANC, if they can get their logistics right, if they can get the buses and the T-shirts and the food parcels ready, people will actually come to vote and they will vote ANC. The DA has to convince people to come back to them. Thus, you have all the stories about the EFF coming from the DA. They're trying to scare the Afrikaans vote back to them. And they're trying to scare people who are splitting the vote back to come to the DA. However, the biggest challenge that I think we will have in terms of the election is the number of parties that are being registered. At the moment, we've got 365 parties. That's without the independents. To give you an idea, 2019, 48, 2014, 29 parties. Look, they won't all be there. It costs a lot of money to register in all 9 provinces and the national ballot. And then, of course, you still have to campaign. So you need a lot of money for that. So a lot of them will fall along the wayside in the process. But ultimately, you know, there's still going to be a lot. So even if you fall a half of that or a quarter of that, we're going to sit like with a toilet roll of a ballot paper, as the Piro jokes there, or, of course, with a whole book. Not a problem for the IEC, but for the voters. Imagine sitting with a voter's roll that's that long. A ballot paper that's that long, right? And you have to kind of figure out where now in this long paper is my party. And remember, it's not just alphabetical, because then you would think the ANC would just be at the top or very high, close to the top. They pull out of a hat the letter, and then they decide, and then it runs alphabetically. Is that clear? Yeah. So big challenge here. Okay, I'm going to show you some polling numbers, but before I get there, can I just do a few disclaimers? We are a very long way off, and in terms of elections now, presumably, because we're guessing it's going to be close to May, you know, towards the end. It's a couple of months away in any case, no matter how you look at it. And remember, an opinion poll is always just a snapshot at that time. It's not a very good predictor if you're this far out still. What's far more better in opinion polls when you're this far out is to start looking at trends, not really at the actual numbers. They're very confusing. If you are going to look at polls and get excited about or depressed about them, I want to give you a few criteria to look at, because in the next while you're going to see a lot of polls coming out. Everybody who wants media attention is going to bring out a poll, and the media will jump on it, and they will jump on the controversial things. But before you actually get bought in by that, just look at these things. They always say it, mostly say it, in an articles, and if they don't say it, you shouldn't pay any attention to it. It needs to be quite a big poll. I like the polls that go over 3,000, because the phone polls are often 1,500 or less, but you can imagine divide that now by 9 provinces and then make them demographically representative. Your sample sizes get incredibly small. I mean, you guys work with numbers all the time, right? So the sample sizes get very small. Secondly, it's really important that it is in person. We know that ANC and EFF voters don't like phone polls, they lie. They sort of, who's asking and why you asking and why you want to know this from me and who are you again, you know, so we know that's much more unreliable. Face-to-face works much better. Of course, they have to be only registered voters who intend to vote. Otherwise, why are you in the poll? It's easier not just to phone up 1,500 people that are over 18, but that's not an accurate poll at all. And then, of course, they have to be demographically representative. So the poll I'm showing you now is the Ipsos poll. It came out 3 days ago. Really big poll, 3,600 people, nice and big, face-to-face, all the good things. However, the fieldwork was done in October and November. So, again, you're getting a snapshot of where people were in October and November, because it takes them a long time to work the data through. Phone polls come out quicker, but when you do this kind of big poll, it takes a while. A small margin of error, 0.65, and then it's a probable choice one, which means that when people say they don't know, or they're not sure, which you often have a big chunk of, usually around 10, 12% still at this time, this far out before an election. What they do then is they cleverly ask you a few subsequent questions around economics, presidencies, that kind of thing. You don't even think it's got to do anything with where you're going to vote. But then their modeling, especially Ipsos, is very good at that. They then know roughly where to allocate you on the basis of your responses, and that's what they call probable choice. And that's the best type of polling so far out still. So you can see it there. ANC sitting at 40.5, or was sitting there during October, November. I'll come back to the MPC. The DA at 20.5. Now the ANC obviously has taken a big dip from 57.5, where they are currently in Parliament. The DA is at 21%, so basically where they are. The EFF, of course, big growth, right? So the EFF is currently at 11%. In Parliament, so you can see there's quite a bit of growth going on there. IFP, basically where they are in Parliament now, at just under 5%. Action SA, new kid on the block, so 4.3%. Freedom Front Plus, where they are currently in Parliament, and then ACDP at 1%. And now I'll give somebody a bottle of wine if they know who ACT is. Anybody have an idea? Tell me. Oh, that man's getting a bottle of wine. The first one on the whole roadshow that knew that. Were you on my previous presentation? So it is. It's Ace Magashule's party. I mean, who would have thought, right? That he would creep in at 1.5%. So the rest of the 365 parties are not getting 1%. That's why they're not even registering on the polls. The MPC is the multi-party charter. That's that moonshot thing from John Steenhuisen. And as you will see everywhere, except maybe a small chance in KZN, they're going nowhere. They're sitting here around 33, 35%. So they're not going to get to 50%, which is the only time that pact kicks in. If there's no chance of them getting 50%, the bets are off and anybody can go with anybody. They don't say that too publicly, but you have to read the charter. So this is Ipsos, okay? The DA doesn't like Ipsos. They say they underpoll them always. Not been historically really true, but just to be fair, I'm showing you very briefly two other polls, Social Research Foundation and Brenter's Foundation. They both came out at the end of last year. As you can see, and in fact, the Ipsos poll came out at the same time, there was no difference in their polling of the ANC. So you can see that's not where they differ a lot. They don't differ really on the IFP. Where they do differ is at the DA and the EFF vote, up to 10, 11%. So that's why I say often it's not that useful to look at the actual numbers because the polls differ so much. However, what was interesting last year and this year so far is to look at the trends in the polling. And in fact, when you put Social Research Foundation in with Ipsos one, they were the two who polled quite frequently last year. It was exactly the same. But what I've done here is I'm just showing you the Ipsos poll. It's just easier, otherwise there's too many lines there. So Ipsos released a poll in June and October last year, and then again one in January of this year. And what you can see is the ANC was on a steady decline. So almost 10% since last year this time. A growth in the DA. Now they basically seem to have hit a ceiling, and the EFF is growing. But I wouldn't worry too much about that last 1%, right? And then you've got the IFP that's staying stable. So what does this mean, really? What it means is it looks like the ANC, and I think because we're so far out, and the ANC usually rallies around 2 months in advance of the election. That's usually when you see the numbers going up. So my best guess is that we are going to see the ANC somewhere around 45 and even a little bit up. Ipsos think that if we get a low turnout, it's because of this rural-urban thing, that the ANC will most probably get 50% or just over it on the numbers that they have now. So depending on the turnout, the ANC is going to be somewhere between 45 and 50, we think. If that is the case, of course, they will need a coalition. Even if they get just 50%, you can't risk somebody being on the loo on the day if they vote on bills, or gets locked in their car or something bizarre happening. It happens. So what they will then do is that they will go first with the smaller parties, the independents, and or the IFP. That's their preferred choice. That's where they'd like to go. And of course, Cyril's happy space is GNU, right? He likes lots of complicated sort of, he knows it from way back. If they then need the numbers, they'll go DA. They do not want to be with the EFF. That is very clear out of every conversation, every WhatsApp that I'm looking at. They do not want to go EFF. There's a lot of bad blood between them and Malema. They do not trust the EFF and their sort of explosiveness. They've learned from local government that it doesn't work very well. They are not happy. They won't forgive Malema for what he did last year with Sona and storming the stage. So this whole issue about the ANC is going to go with the EFF is actually something that the DA designed to scare people, as I said earlier, to come back to them. It's the same tactic they used under Zuma. Was to say, don't fragment the opposition vote, come back to us. They did it quite successfully then. So EFF will only be the ANC's choice if it is the only way to stay in power. And then really you have to blame the DA for not playing ball, because then they are demanding too much. So if we end up with the EFF ANC, it's almost certainly the DA's fault, because they didn't come to the table to form the coalition, because that's definitely not where the ANC wants to be. The MPC, like I've said, is not going to make much of a difference. And I think if the ANC needs the DA, they will most probably also bring in the IFP. Because Cyril wouldn't be comfortable, he's already constantly under pressure with the whole idea that he's too white and goes too much, to the white business side. And I think he'll feel more comfortable then bringing in the IFP as well. Okay. So before I go to the provinces, just quickly 2 more slides. The first one is there's going to be a lot of noise in the next while until the election about all the smaller parties. Of course, the media gets bored, rightly so, about the same old, and the smaller parties do need and deserve some media attention. But in the end, the 3 biggest parties still get 80 to 90% of the vote. Yeah? And if you put the IFP in there, you're actually at 90-something of the vote. So the game is still with the big parties and the big elephants. Then this one I quickly wanted to show you is just the popularity ratings of the leadership here. Politicians don't do too well. Nobody gets above 50%. Cyril is still the most popular leader in South Africa, way over 40%, or not way over, but just over 40%. Julius Malema comes in second, maybe unsurprisingly. The one that did surprise me was Tannie Hillen. Is still there, right? Number 3. Surprising, yeah? I'm not the only one, right? Mmusi Maimane comes in 4th, and then just look at the John Steenhuisen thing. That's where the DA is encountering a problem. Look, he's only 4% points above Pieter Groenewald. Pieter Groenewald, a 2% party. John Steenhuisen, a 20 to 30% party. He wants to be closer to the 30%. That's a problem. And the DA's problems are lying in their leadership issues. And that needs to be addressed. And then you've got the IFP at about 6. Songezi Zibi from Rise Mzansi is actually doing quite well in his personal capacity, not so much the party yet. We're not seeing the party there. Okay, let me quickly talk to you about the provinces then. I'm going to talk to you just about 3 provinces, KZN, Western Cape, and Gauteng, the 3 provinces that we think will not go ANC. So Gauteng, the one thing the polls agree, the ANC is under 35 or around 35. They will need a coalition in Gauteng. Polls differ vastly between the different political parties. I'm not going to go into all of them, but as you can see then, if you're starting to talk coalitions, what you're having is the ANC-DA is quite a comfortable one, and let's hope that's the way it will go. Alternatively, ANC-EFF will also bring you over the 50% mark. The MPC is around 37% multi-party charter, so not enough. If they then want to bring in loads of other small parties, they could possibly make it. But then, of course, you're back to the Joburg scenario, right, where the parties can fall away. Somebody has a fight with his wife in the morning, and now he's like in a bad mood, and he draws out of the coalition, and then the coalition falls. And you don't want that at a provincial level. It's bad enough that it's happening at local level and has disastrous impacts. So Gauteng, definitely a coalition, most probably either ANC-DA or ANC-EFF. KZN, the polls are all over the show. Really, really difficult in KZN to know what's going on. I think it's indicative of the complexities of KZN. But as you can see, they differ more than 10%. All the parties, it's like major differences there. So at the best guess at the moment, what we can look at is they will need a coalition, because neither the IFP or the ANC is going to get a majority. But it's either an ANC-IFP, which would bring you over 50%, DA-IFP, maybe close to 50. They're very excited about this. And then, of course, also the MPC is quite close to that as well. So we will have to see in the next few polls what happens around the the DA and IFP coalition. The one factor, of course, that we do not have a clue about at this stage yet is the Zuma influence. It's too quickly to pick it up in the polls. My best guess at this stage is it won't do a lot nationally, but it could do a lot in KZN. And the ANC is definitely very, very nervous about it in KZN. Then our province, Western Cape. So the one thing all the polls agree on, ANC is down very low. They're nowhere. They're in 20 something percent. The polls are sort of all around there. There's a big difference, however, when you look at the polls about what the DA's numbers are. The DA themselves says they're at 60 something. Yeah, I think that's a bit opportunistic, or optimistic, rather. The polls are sort of the reliable polls are somewhere between 42 and 56%. Look, I think that it will be a majority. The question is just how big. And the thing that's now going to impact on them if they don't pull this back very quickly is in fact their position around Gaza and Israel. The Muslim population in the Western Cape is 6.6% of the total population, close to 7%. And the imams are now openly calling for the Muslim vote not to go to the DA. And so that could really impact on the DA's majority. Of course, we've also seen, and again, apologies, a fragmentation of the colored vote, very, very significant fragmentation that's happening there. Some are going to the Patriotic Alliance, some are going to the sort of colored nationalist type of parties. We're seeing a lot of fragmentation happening there. And of course, if you look at the demographics of the Western Cape, you cannot win the Western Cape without a significant percentage of the colored vote. So I personally still think the DA, from what we can see now, will win the Western Cape, but it's not necessarily going to be a comfortable majority. And we will really have to see what happens in the next while with the polling and whether they can pull this Gaza issue back, because it is definitely hurting them. So just briefly, in summary then, a long way still to go. The ANC remembers rallies in the last 2 months, always pre-election. We will see a coalition definitely in KZN and in Gauteng. Western Cape, a question around the majority, and then of the DA, and then when we look at nationally, most probably around the 45 and upwards, and then if they do need a coalition, they'll go first, smaller parties, IFP, DA, and then lastly, if they don't have any other way to go, they will go EFF. So what happens after the election? Analysts like to make this incredibly complicated. It's not. So votes get counted at the polling stations, of course, with all the political parties there, as you all know. Mr. Zuma clearly doesn't, but they are, so it's not in secret. The votes then go to the IEC Centre in Pretoria, where, again, the political parties are present. They collate it. Once they're comfortable with the numbers, they release it. And they announce the election results. So it usually takes about 2 to 3 days, but there is nothing actually that says how long it should take. So it could take, and most probably this election will take a little bit longer with all the parties. Once the results are announced, the Chief Justice has to, within 14 days, so no later than 14 days, call for the Parliament to come together. They swear in the MPs, and then they elect the Speaker and the Deputy Speaker, and then there is nominations called for the President. Any MP can announce or can nominate a presidential candidate, and then they vote, and whoever gets the most votes wins. You don't have to get 50%. You just have to get most of the votes. If there is 2 candidates getting the same vote, the Constitution provides for a runoff. But otherwise, it's just, you don't actually need 50% to run the country. And then what happens is, of course, the president gets sworn in. He or she then puts up their cabinet, and then the country goes on. So it's not a very complicated process. But if the ANC does not have 45%, one would assume that they would have their coalition agreements in place. Because otherwise, of course, you run a huge risk come the day where the president is going to announce that the opposition all come together and then they can vote you out. So they would have their coalition agreements most probably in place, or at least some loose agreements in place to get the president elected. And people often ask me, what if they can't get it together? They will. I'm not worried about this, especially not if Cyril is there, and I'll talk about Cyril in a second. Because this is his happy space. This is where he negotiates. This is where he brings people together, and the deals will be made. I'm not concerned. If it really, if they can't form a government, the Constitution says you have another election in 90 days. So please, Lord, let that not happen. We don't need that. So then the last question that I always get asked is, who will be the president? So look, it's almost certain going to be an ANC president, whether they get a majority or not. They will still be the biggest party in the country. Cyril Ramaphosa will be with us, except if something happens absolutely catastrophically. Either for him or something that comes up. So he will definitely take us through the elections, and I think in the transition afterwards. The question then is just, how long does he stay? And if you've asked me about a year ago, I would have said most probably not too long, because he looked, I know him quite well, like my kids would say, it looked like he was over it, and it did really look like that. And I think the Phala thing really upset him greatly, and he didn't want to be a distraction. But that's changed. He seems to be a lot more confident, a lot more happier in his skin again, and there seems to be a little bit more of a comfort with him and everything in the ANC as well. But I doubt, look, he won't go to the full term, right? Because remember, he started before an election with Zuma, remember? So, and he can only do 10 years. So the question is just, does he go all the way through to the next ANC conference? I doubt that. If he's asked to do a successor now, or to announce a successor, it's most probably going to be Paul Mashatile. But of course, we have to see with Paul, right? Because there's a lot of questions about the money and the girlfriends and so on and so on. The girlfriends is not so much the problem, but certainly where's he getting all the money from? And is that a problem? So that's still, we'll know that. It will come out increasingly over the next few months if there is indeed a big problem. If it's not him, then the question is whom? A bit more difficult to say there. Of course, Ronald Lamola is definitely standing in the wings, but he is young still, very young for a president. So it's a bit more difficult to predict then. I mean, there's a lot of guys who'd like to be president, but it's a little bit more complicated to know because there's not an obvious front runner then to do that. But whoever it is, and this is interesting because when I speak to the foreign investors, the one thing they are interested in is, one, where would the new president be ideologically? In terms of the private sector and the markets. I'm not worried about Paul in that case, not at all. And I think you can take a deep breath if it is Paul from that perspective. And then what they want to know is, will it be a peaceful transition? And that I have no doubt about. I'm sure Cyril already in his own head, and maybe he's even discussed it with Paul or so on, when he'd like to go. And it will be a peaceful, proper transition. It won't be the kind of Zuma scenario. If the ANC does very badly in the election, then I think it will happen sooner than later. So we'll have to have a little look at that. So my time is up. I just want to say, look, sometimes when I show people this presentation and you get a feeling that people get slightly disappointed because they were hoping for really big changes, and they get from the media, it feels like there should be a lot more changes, and then they think, well, it doesn't look that way. And undoubtedly we have a lot of challenges in our country, despite what the president said last night at SONA. Of course we have a lot of challenges in this country. And of course, elections always doesn't. The election periods itself is not great for any country. First of all, you can't get hold of any politician because they're all running around canvassing. They're not doing their policy work. They're not in parliament where, often where they should be. It's a difficult time. And then you get a lot of changes. You get in different cabinet. You get different committee chairs. You get different things in parliament. Some of it, which is usually good, but a lot of it can also not be so good, as we saw with the last changeover. So it's not a great time. However, if there's one thing that we should be really proud about in our country, it is about our democracy. It is about the fact that we are now 30 years down the line, and we are able to still have very peaceful and very organized elections, and we have peaceful transitions and peaceful handovers. And that was never a given when we transitioned in 1994. And in most developing countries like ours, it is not 30 years down the line the case anymore. I have no doubt. People keep asking me, how do we know this election is going to be free and fair? I get that with every election since 1994. And there's never been a reason to not think that it was free and fair. And I have no reason to, again, worry about that. And I think we will have a peaceful, free and fair election this time around. And of that, we as a country should be extremely proud. Because that's a big deal. Ultimately, everything we do in this country rests on that. And of course, then after the election, we'll start doing the good fight again about everything else. Thank you so much for your time. And I hope this was helpful for you to understand a little bit better what's going on. Thank you. Bye.
Thanks very much, Melanie. I always say there's nothing like politics to get you going in the morning, just before a weekend. I really enjoyed that. So nice to see some of you, all of you. Really nice to see some familiar faces and spend some time with you. There's really kind of three types of people in this room. There's the people who own our funds directly, and hopefully we'll have something in this presentation that you'll find useful. There's some of you who participate or partner with us indirectly, perhaps you with a DFM or a multi-manager that uses us, and therefore hopefully some of what we have to say might help you. And then you got some in the audience that are thinking about using us. And again, I hope there's some food for thought for you as well, and something that you can take away here. But regardless of your reasons, really nice to have you with us. I think just a little bit about me. I'm part of the PSG Asset Management Investment Team. I'm the head of equities. I also help look after the PSG Balance Fund. Yeah, I think what we're going to talk about today is I'm going to give you just a little bit of an update on us. There are some new faces in the audience, so some of you might benefit from this. A quick look back at 2023. There's a couple of interesting insights there that we think is interesting. I mean, it was an interesting year, so I'll touch on a couple of things that we thought were important. And then looking forward, I think what you do with this essay question, I think is top of mind for any investor in South Africa. And it's no different for us. So we've really been giving it a lot of thought recently, and have some hopefully some interesting thoughts to share with you. And then I'm going to bring it all together. What's quite nice is to make it quite tangible. I'm just going to give you a snapshot of our portfolios, how we're positioned, and how we're trying to balance the different factors. So just a little bit about us. You know, we're part of the PSG Financial Services Group, and we're really the specialist asset management arm of that group. We run about 50 billion rand, but just over that 53 billion rand of assets. A big chunk of that, about 40%, is global assets. The rest is domestic. So we invest globally from Cape Town. We've been doing this since 2008. So really we've been following this integrated offshore investing capability for a long time. And I think we've built something that is really credible and has added a lot of benefit to our investors, which I'll show you a little bit later. So it's really about performance for us. That's why we exist. So we're quite proud of our track record. And I think the key thing to say here as well is the clients that get the best use out of us tell us that they see the benefit of us playing a diversifying role in a portfolio solution. And the reason for that is we have funds that look quite different from the average fund out there. And we can play a very valuable role in that context. So just a bit of an update in terms of how we're doing. We continue to march onwards. You know, we're really thinking about the long-term numbers here. These are just our largest funds. You're really across the different asset capabilities from equity, multi-asset, income, and global. I think we're making good progress. So we're confident our system and our process works. We have something valuable to offer the market. I think a nice way to maybe just summarize that is the Balance Fund is really where it all comes together. It's our multi-asset fund in the high equity space. And I think over a nice long chunk of time, what we've done here is we're just showing you the 10-year alpha analysis. We've been 2.5% above peers. Okay, so that's a peer benchmark there. And then what we've done is we've just shown you what the different capabilities have done relative to their indices. And I think one thing to point out is we're very pleased that we've been able to consistently deliver value across all the capabilities. And I think that's quite a powerful place to be. And I think it's something we continue to work very hard on getting better. We're particularly proud of the global equity piece. It's been a really, really tough decade to beat global indices. I'm sure you would agree. And our global capability that again we've been investing in since 2008 has been a very valuable part of what we do for our investors. Okay, so let's look back at 2023. I learned one thing which I suspected, but I now know for sure, and that's that Jay Powell obviously has some equities that he's quite keen to keep quite strong here. So he's got his dual mandate over there. No, I think that's to be more less joking. I think it was an eventful year with actually a lot of challenges. So at the beginning of the year, as you remember, we started with a lot of negativity, a lot of recession talk, and a lot of interest rate hikes. So really what happened here, and we've just shown you by quarter some of the key things that have happened. Material interest rate increases across the developed markets. It's really been the fastest single increase in monetary tightening that we've seen. And you've seen some bank failures as well. So Silicon Valley Bank, First Republic, Credit Suisse. So really levered financial institutions that were not prepared for this interest rate increase and were and hadn't thought properly about their duration management. Really struggled. So that happened. It didn't seem to stop the equity market though. It kept on going up. The other thing that was interesting was the dynamics around the US debt markets. So the US is running very hot fiscal policy really for the last few years, and they've got a lot of issuance to come. So they need to issue a lot of bonds. They have been issuing a lot of bonds, and we haven't even been in a recession yet. So they're sitting at very high fiscal deficits. If we go into a recession, it could get very interesting for them. So the bond market is trying to grapple with this. So you've got the highest treasury rates in a long time, really culminating in the third quarter. You had a bit of a rally in the final quarter, but that's something that was quite interesting to observe. And then clearly we had a lot of talk around AI, ChatGPT launched, and different iterations were developed, and then a lot of geopolitical conflict as well. So overall, an eventful year. As I said, J-Powell kind of saved everything at the end with some soft landing talk, and global equities gave you a nice chunky 24%. So kind of when we think about it, another big and very important development has been inflation. And we found this really good inflation index on Twitter /X, and it's the Braaibroekie index. And it's a carefully weighted index, including onions and chutney and bread and a couple of other things. And it's a bit lighthearted, but I think it does give you a pretty good feel for what inflation's been like. Obviously, prices always go up, but you've had a couple of years where inflation got really high. So price increases have been very high. This is a global phenomenon. It's obviously just partially reflected here. But what you can also see is you can see a little bit of normalization now. So inflation's coming back to trend. And I think that's, again, reflected globally. And I think people are celebrating this. Markets are celebrating this. I think people are generally expecting interest rates to normalize now and things to get back to normal and get back to the races. The one observation we just make with this is just to be aware that, yes, there will be some normalization. That's inevitable. You have quite a high base in many prices that needs to normalize and is normalizing. But we would just point to a couple of other examples in history which we think are worth studying, and they just give you a bit of a sense of what could happen. And we think the 1940s and the 1970s actually had a lot of similarities to where we are today. Geopolitics was a big theme, big underinvestment in the old economy were big themes in all of those times. And there were a number of other interesting similarities. And what you saw, which was common to these, was an initial wave of inflation, and then kind of normalization, and I think a bit of relief, and then a very serious second wave, and potentially more of those as that inflation problem emerged and people realized it hadn't been fully eradicated. Our sense is the market is fairly complacent on this. If we look forward in terms of what the market is pricing in for inflation, it's pretty low globally, really low single digits. And we would be making the point here that I think one wants to think about in multi-asset portfolios, in all portfolios, is just making sure you've got enough inflation protection. So a lot of people talk about hedging. Do I have a recession hedge? Do I have a market hedge? A good question for you to ask is, do I have enough inflation hedges in your portfolio? And we've got a couple of ideas about that. Obviously, you don't want to pay for hedging, overpay for hedging, but we do think you would be wise to have some assets that would perform well if you did have a second wave. Okay, getting back to the US, it was obviously a very concentrated market. You had 7 shares, the so-called Big Seven, Magnificent Seven, which delivered almost 3/4 of the global equity return. So very concentrated. You're seeing those concentration ratios really show, echoing a couple of other times in the past. And then this year is really interesting. The last couple of months, the concentration's gotten even narrower. So I think some of those Big Seven stocks have kind of fallen off the back. Tesla's down almost 30% year to date. But it's still marching on. Some of the big ones are still going on. So it's getting narrower and narrower and narrower. And it looks really unhealthy to us. So some of these shares have been propelled up by very good earnings trajectory, which I think is more healthy. But not all of them have. A lot of them has been ratings and expectations led. And what we've done here is quite an interesting study that just looks at the percentage of S&P 500 constituents that are underperforming the index. And what you'd expect in a normal year would be about 50%, and that's kind of what you can see. Through time, it averages around 50, so half the shares outperform, half the shares underperform. Makes sense. Every now and then you see quite unhealthy behavior where it's a very narrow portion of the market that is doing all the work. And that's normally worth taking note of. So the last time we saw data that like we saw last year and what we're seeing so far in the first few weeks of this year is 98 to 99, just prior to the dot-com bubble. It's unlikely that we're going to have exactly the same experience as that, but I do think it is worth noting. The market dynamics, ultimately, primarily driven by mega cap and very large cap shares, do look quite unhealthy to us. So our conclusion with this is just think very carefully about diversification and make sure that you're not over-concentrated in some of these areas. Okay, so just looking back at the last couple of years together, I think it's important to put 2022 alongside 2023. Otherwise, we get too excited. And I think what you can see is you've had effectively quite an average, mediocre time for global equities. It's been hard to make money generally over the last few years together. So global equities had a good bounce back, as we know, driven by this handful of shares. Global bonds has been horrible. I mean, this is a risk-free, supposedly risk-free asset. It's actually created a big headache for a lot of investors, a lot of pension funds. I think we saw a little snapshot of that in the UK with the LDI funds and the gilt market. What is really interesting to us is just observe how correlated global bonds and equities have become. I think that's really, really worth just circling in your mind and banking. It hasn't been like this for 15 years. The last 15 years and more, really the last 40 years, global bonds have played this beautiful diversifying role in asset portfolios, where they move as a contra asset to risk. Really, when you have risk off in growth assets, you could rely on global bonds to give you support. It looks like the last 2 years that hasn't been the case, and for a variety of reasons, which I won't get into now. But what's really interesting for us going forward is we think one probably needs to be a bit more creative than just reaching for what worked over the last 10, 15 years in terms of building robust portfolios. We're not sure global bonds are going to give you that risk mitigation. In fact, that we think they'll probably be amplifying some of the equity risk that you do have in your portfolio. So that's just a side comment on the global side. If you come back to South Africa, what you can see is SA equities, SA bonds have given you effectively inflation returns if you add the years together. And you can see how broadly our multi-asset funds have done alongside that. So we're trying to eke out some value, but it's been a tough 2 years. I think we're pleased with how we've done it. We've given good CPI beating returns, but it hasn't been an easy 2-year period. Okay, so let's look forward. That's looking past. Let's look forward. And I think we look into SA. The big question that we're grappling with, and I'm sure you're grappling with, is what do you do with these flipping cheap SA assets? Do you kick them into touch and not bother, or is there money to be made? Are they value traps or are they opportunities? So when we look at it, I mean, it's clear why things are the way they are. I think we all know the challenges that we've got in South Africa, like really, in many cases, unhelpful and counterproductive politics and signaling and policy choices. Eskom as being a big issue. I mean, I think if you get into the macro itself, the detail, it's very concerning. This is not something to be taken lightly. We're not naive to this, and we really would encourage you not to be either. There's some real serious issues at play in South Africa. We are effectively in a crisis. And in fact, being a South African feels a little bit like this guy. It feels like you've been beaten up over and over again, and every time you think you're getting up again, you get beaten down again. But this guy's a world champ. Drickus, obviously crowned champion in mixed martial arts. The joke with this on that side is that he's first in the world, but he'd probably come 7th in Brakpan. And I think if there's anyone from Brakpan here, deep apologies. You can find me afterwards. Yeah, so what's really helpful when kind of bringing this all together is a point I want to make in investing is nuance and complexity often go hand in hand. And what we find really helpful is this Chinese word for crisis. The Chinese have been around. They've got a civilization more than 5,000 years old. They've worked a lot of stuff out. And interestingly, they got a word for crisis. It's those two characters together. And each character is actually a separate word. That's how the Chinese Mandarin language works. And the first one is this character called Wei. I think I'm pronouncing it right. Wei, which means danger. Okay, so it's the symbol for danger. You probably find that when you're driving and there's a pothole, they probably have a big Wei sign over there. And that makes sense, right? We're in a crisis at the moment in South Africa, and it's dangerous. Every time I buy a South African share, it feels a little bit dangerous. Gives me a bit of a rush. But what's interesting is the second character for me is fascinating. And remember, they go hand in hand. This is what crisis is. It's danger, and Ji means opportunity, or inflection is the other interpretation. So it's this concept that in danger there is opportunity as well. And in fact, often opportunity only exists because there is danger. You cannot separate them. You cannot have opportunity if there's no reason for the opportunity. The world unfortunately does not give us those free lunches. So what we want to say, and what the conclusion we've come to, is that there are dangers, there are risks in South Africa. You want to be very sensible about how you construct your portfolios, and I'm going to give you a few ideas about that a bit later. But it does seem to us that the temperature towards South African assets at the moment is very, very cold. It's very cold, and when things are cold like this, there's often an opportunity to make good returns. And that's certainly the backdrop that we see ahead of us. So what I'm going to do now is I'm going to take you through a little bit about how we think at PSG Asset Management. We're really trying to be rational. We try and develop our investment decisions through evidence. So what I'm going to do is very simply just lay out a few pieces of evidence for you. And I'm going to try and show to you that there's a rational argument that there's good returns to be made in South African assets. And then I'm going to close by giving you a sense of how we've constructed it into portfolios so we get a nice balance and we're protecting the downside as well. Okay, so the first place to start is have a global perspective. You cannot do this without a global perspective. Okay, so having a global perspective really helps. What we've got here is really the trade-weighted US dollar. So it's the dollar versus its big trading partner currencies. And what you can see is the dollar goes through these beautiful, long, and quite powerful cycles. So starting back in 1969, you had 11 years where the dollar was weak. Okay, then 5 years where the dollar was very, very strong. Those were the Volcker years. 11 years where the dollar was very weak. 7 years of strength, 7 years of weakness. And then 15 years, this is very notable, 15 years of dollar strength after the GFC, and it culminated in 2022. That's really the longest cycle we've seen so far. And we suspect many market participants have forgotten what the other cycles feel like. Okay, so a lot of market participants probably, we've been in this epoch for so long that we've kind of gotten used to it. It's US exceptionalism. The US is always going to be the place to be. The US is always going to be strengthening. The US dollar is always going to be strengthening as a currency. What's quite interesting for us is that the last 2 years looks like, and we have to see more data to confirm this, but it looks like increasingly likely that we're in the very nascent stages of a new dollar weakness cycle. And I think that can have material implications. Now, there's going to be some people in the room here, and I can really see it on your faces. You're like, yeah, it's very interesting, Justin, but that's got nothing to do with SA. Why are you even bringing this up? It's actually got a lot to do with South Africa. And the reason for that is because South Africa is a bit of an irrelevant country at the southern tip of Africa, but we are a commodity exporting emerging market. Okay, I think that's a very important point. And what you see here is, we've just shown you 2 data points here, but you can actually, it's reflective in the data if you go back further, is emerging markets really like weak dollar cycles. And it's for a variety of reasons. Commodities tend to do better. The sentiment towards them is much better. Their financing arrangements and their financial conditions is often much more easy in times of weak dollars. What you can see in the last weak dollar cycle, and some of you with gray hair or no hair, I can see a few of you here, like you'll remember what it was like investing in South Africa in 2002 to 2008. South African equities compounded in dollars 36% per annum, triple what you got out of the US. So there was an enormous enormous amount of upside. And that was really an EM story. It had probably very little to do with South Africa. It was about EM. And then in the strong dollar cycle, similarly, you find EM it's a headwind, it's a constraint, and South Africa faced no different. So the conclusion from this is if we are going into a weak dollar cycle, which we think looks increasingly likely, this is a very important external global factor, which could be very supportive for us. So I think we should take note of that. Okay, let's bring it back to South Africa now. There's a few constraints that have been on South African assets specifically over the last 2-3 years, which we think are cyclical or temporary and could ease. They're not going to go away completely, maybe, but they're definitely going to get better in our judgment. So the first one is interest rates. So the repo rate is the highest it's been since 2009. And what we see is reasonable prospects over the next 2 years of that coming down. There's a lot of room here for the SARB, just to bring that in a little bit. And the way we're thinking about it is you've got CPI that'll probably average around 5%. This is not precise. I don't have decimal points for you. Generally speaking, the SARB would be looking to keep real rates quite tight at between 1% and 2%. Okay, so they'd want interest rates above inflation because of some of our fiscal risks. And that creates room for about 1 to 2.5 or so percentage of rate cuts over the next 2 years. We think potentially starting at the latter stages of this year. It's obviously a big thing that is needed for this to happen is the US needs to be cutting as well. Okay, so that's kind of a given prerequisite. That's quite a material difference, eh? So 1 to 2.5 doesn't sound like a lot, but it's 15 to 30% reduction, and it's going to hit consumers positively, so more discretionary income. Corporates are going to have a big benefit from this. A lot of our corporates in South Africa borrow on floating rate basis, so they've had to eat all of that rate increase on the chin. It's captured in their P&L, it's now in the base. If that starts coming down, you actually have quite a big support to earnings growth. And then sentiment and PE ratios and valuations tend to follow interest rates. So the cost of capital just easing a little bit is normally better for all asset prices. So you've got a couple of potential factors that could be positive here over the next couple of years, which we think we're not really paying for here. This is stuff that could be additive. The other one is energy. Energy has been a big constraint last year. It's hit us from a GDP growth perspective, obviously. A lot of our companies have struggled with revenues, so people haven't been able to buy their products and services with load shedding. It's hit their P&L. They've had to spend capex on solar systems and batteries. So it's been a big issue. What we see going forward is quite a lot of capacity coming on, and it's all private sector effectively. So it's private sectors becoming self-sufficient in this country. So really diversifying away from the state. And we see decent improvement this year already, 2024, but the big kick is going to be 2025 and 2026, with a lot of private sector capacity being installed. At the same time, we've got some big units, Medupi and Kusile units, which have been offline and been having issues. The private sector has been getting quite involved in helping them get back on track, and there have been 1 or 2 that are coming online or have come online. And there's a number of other initiatives at play which are happening, and most of it is large corporates or individuals, people like you and me, just spending our own money and trying to get the hell off Eskom. So at the end of the day, actually things look quite bright on this perspective. We think load shedding will be less of an issue in the future. This is a very important point that I want to make. A lot of the time, I think, when you hear investors and some of my colleagues in other companies talk about a negative view on South African assets, a key part of their reasoning is that South Africa has no growth, which I agree with. We've got very low GDP growth. But they make a mistake with the second part of the argument. They assume that it means that JSE companies therefore have no growth, and therefore we must just go offshore because they must all be value traps. That is 100% not true. And what we've shown here is just a bit of a sense on some of our portfolio companies, just their revenue growth over the last 2 years. And we've done this over different time periods. So I could show you a similar chart since 2019, over 3 years, over 4 years. COVID kind of messes things up a little bit in between. But whichever way you want to slice and dice it, there's a broad representation of companies on the JSE which have shown way better than nominal GDP revenue growth. So these pockets of growth exist. We've given you 2 examples here. One is the leisure and tourism sector. So we've got big holdings in Southern Sun and Sun International. December and January, we're breaking new records from a tourism perspective. So it's the one sector that will benefit from a weaker rand. And we're starting to see that come through quite nicely. And then the other one is infrastructure. We're seeing, off a very low base, we're seeing quite consistent infrastructure spend coming through. So Sunroll's injecting substantial amounts of money into roads, but we're seeing it in renewable energy, we're seeing it in border posts, and there's a number of companies which are benefiting from that, which are available on the JSE. The one side point I'll make here, and I'll come back to this a bit later, is you need breadth to access these pockets of growth. Okay, if you are a massive asset manager with big AUM, you can really only buy the top 20 companies on the JSE, and they might not have access to this revenue growth. But if we are mid-sized, and that's kind of the sweet spot that we're in, and there's a few other asset managers that are like us, you actually have a very wide opportunity set. We can really invest in the top 100, 150 companies on the JSE, and that's a big opportunity set. That is more than sufficient, and within that, there are these pockets of growth. So I think breadth is a very important prerequisite for accessing this growth, but it does exist. Okay, and just to give you a bit of a feel for why that excites us, is I'm just going to use the construction companies which we own. We own WBHO and Raubex across our funds, and not only is growth coming through, but there's nobody left to participate from this growth except these guys. Okay, so capacity has fallen 60% over the last decade, as Burries and Avenge and all these other guys have gone out of business. And what it means is the remaining participants will have higher market share, command better margins, and just be much better businesses than people think. And these have not been historically great businesses. I think the mistake that investors make today is they look into the rearview mirror and they think the next decade will be like the last decade. And they're radically different. The competition set is different. These guys have a lot less competition. By definition, they are better businesses. They're going to be making better cash flow, better returns on capital. And just to kind of give you a quick sense of what that looks like, for these two companies, you've seen order books explode over the last 2 years, and this is continuing. I mean, I haven't updated these numbers in about 6 months. So I think these numbers have gone up a lot since then. And that revenue is going to be programmatically coming into the business, and margins look stable to better. These guys are signing better margins because there's little competition, and they're available at giveaway prices. So it looks like a real bargain to us, and it's just a small snapshot of the type of opportunities that we do see on the JSE. If I kind of zoom back a little bit out to the broader market, what we've shown here is just a way of just getting a feel for the temperature of how hated and despised our market is at the moment and what that means for opportunity. So we've shown you the price to book relative to that market's own 20-year average. So these are not discounts to book value. These are discounts to its own average. So the US market, for example, is 53% more expensive on a price to book basis than it's been on average over the last 20 years. And that's through all those different cycles, including the dot-com cycle. So it captures in, it's quite, I think, indicative of something normal. So the US and world by implication, given the US is such a large weight, looks pretty extended to us relative to history. On a global basis, we're finding a lot more opportunities in places like the UK at the moment. We really like the UK. It's really been a fruitful hunting ground for us. We continue to find opportunities there. Emerging markets look really interesting. They also look cheaper than they have been historically. And then SA is in a category of its own. And if you're able to go a little bit smaller, there's even better opportunities there. So I think that gets the odds in your favor. And the last piece of kind of, let's call it evidence that I'll point to, is that some of these are somewhat technical, but they're incredibly powerful, is that SA assets are really under-owned. You've had enormous foreign equity outflows. That's obviously been a big headwind for the last 5 years, as almost R1 trillion has flown out of our market. Global emerging market investors are at maximum underweights in terms of general global EM indices. So South Africa is at a maximum underweight at the moment. SA retirement funds, if you look at the surveys, are all at the lowest SA exposures than they've ever been. Okay, a lot of that has to do with Regulation 28. But the reality is these guys have all sold down and they're now at the lowest point they've ever been. And then even our bond market, foreign bond holdings have come down a lot. So a lot of investors or clients will look at me and say, none of this is good. This is surely a reason not to own SA. The reality is when things look like this and nobody's left anymore, You only need a little bit of positive news or things to be a little bit less bad than what you think. And you can have an enormous response in asset prices. So technically, this is a very powerful place to be because your positioning is on your side. Everybody's short. And you have quite a high probability of just a little bit of incremental buying as things normalize in the coming years. And we're starting to see pockets of this. So quite a nice thing is that we look for is tells or little signals that we're kind of getting to a point where this has played out and it's reasonably exhausted. And the two key things we're monitoring are delistings. So this is the signal where you got knowledgeable insiders, so either competitors or foreigners or private equity or somebody that's done a hell of a lot of work and is willing to buy these companies outright on the JSE. So you're seeing delisting activity pick up quite a lot. You see the French are coming for multi-choice last week. It just gives you one example. And then the other thing you're seeing is companies themselves are buying back their own shares. So that's also an interesting thing that we're seeing more and more of as we go forward. So we think the platform is right at the moment for quite a good outcome in the future. And just one way of maybe just sensitizing this a little bit is an exercise that we've done where we just track the upside, the change in potential from where the share prices are trading to where we think they're worth. And we have a reasonably conservative estimate of fair value for most of our companies. And what we've done here is just for our portfolio holdings. We showed you the last decade of how that's looked over time. And what you can see is every now and then you get these times where South African assets just get really discounted. And in late 2015, I think you'll recall that was when our finance minister, we went through a couple of finance ministers in a weekend, and the market got very negative SA assets. And that created a good opportunity to be buying good SA assets at very good prices. The subsequent 2-year return out of our SA equity fund from there was almost 20% per annum. So we did very well from that point. So that was a great entry point. I mean, COVID, a few years later, was obviously a once-in-a-lifetime opportunity again. Things got so discounted there that you actually made 55% per annum over the next couple of years. So you do get these opportunities when things are that cheap. What's interesting to us is last year we got a similar opportunity. It's kind of in that range where you're almost getting these super return potential. And it was because we had load shedding, we had politics, we had high interest rates globally, people talking about recession, et cetera, et cetera. So our SA assets were discounted quite a lot. And we saw a similar valuation opportunity there. So obviously we don't know what the next 2 years will hold. We'll try and make a point to remind you in 2 years' time, and we'll see what happened. Maybe it'll be different. But if history's any guide, it looks like the odds are reasonably in our favor. Okay, so that's our thinking on SA. And I think I want to emphasize, this is not bullish at all costs. This is not go out and buy the index with everything that you have. This is do it responsibly. But we think it's very important to differentiate about being positive on South Africa and where we are, and being positive on the potential to make money from South African assets. Okay, they're two very different things. And I think and my colleagues are as concerned as we all are, I'm sure, about where we are as a country. But we're quite excited about some of the potential we're seeing in the shares that we own. So let me just bring it to you in terms of what it looks like. So I'm going to use the balance fund just as a snapshot because it brings it all together, and you might find it useful. So firstly, just to give you positioning, growth assets versus fixed income. We had an elevated growth assets perspective right now relative to history. That's deliberate. Shouldn't surprise you. We think SA assets are very attractive. We also think the global assets that we own are also very attractive. And we think there's a great opportunity in growth assets generally, so property and equity. And then we got fixed income and cash of about 22%. So this is a growth-seeking portfolio and a growth-seeking position that we've got over the next 3 to 5 years. One thing to say is we have moderated, some of you might find this interesting, we have moderated the equity risk that we got in the portfolio by buying put options on global indices. They're just very, very cheap at the moment. There's a lot of complacency out there. And so we've got quite a lot of protection for a big crash, which we think is additive. So it helps us, it gives us confidence to deploy our stock picks into growth assets, but we've protected our overall portfolio to some degree. Okay, then just to show you, we've got about 29% direct offshore. That's come down. At the beginning of last year, well, about a year ago, we were at about 35, 36% in the balance fund. So we've been bringing money back from offshore, and we've been investing it in some local opportunities over the last year. So we had about 29.71. We would expect to increase that again at some point when our time is right. If I break it down, this is actually a more useful way of looking at it. We think you actually need to be considering the rand hedges and resources as part of your offshore bucket. It's a little bit silly just to look at whether something is listed on the JSE or not as being a relevant driver of risk. So there's some companies on the JSE that have nothing to do with SA. Okay, so what we've done here is we've just given you a bit of a sense of about half of the portfolio is exposed to what we call SA risk, and this has increased over the last year, as I said. So we tactically leaning into that green area a bit more. It was lower. And then we're balancing that, so we're diversifying that with an offshore and resource bucket on the other side. And just to take you through the different pieces quickly, the biggest piece on the SA side is SA Inc. Equities, and these are some of the companies that we own. Some of these have been recent purchases for us, and some of these have been long-standing purchases that have been in our portfolio for a while. Then SA Bonds continues to look exceptionally good to us, despite the risks. I think you're basically getting overcompensated for the risk that you get here. And because you're getting such a high coupon, such a high interest yield, you're getting your capital back very, very quickly. So it actually de-risks you quite quickly. Even if we don't think it's likely, we think it's very unlikely. But even if our government defaulted in 10 years' time, you'd make all your money back plus more. You'd actually make a decent IRR on these assets, just because you're getting such a high interest component every 6 months. Okay, so we've got that. We've also introduced some inflation linkers. We think inflation linkers can play a very powerful role in giving you a bit of that inflation hedge that I was talking about. The other inflation hedge, which I think is very important, is resources. And again, we've blended this, both JSE and offshore. We're agnostic about where it is. We run an integrated portfolio approach. So we'll go and find the resources that we think will do the job for the portfolio, regardless of whether they're offshore or local. We've got quite a nice blend here of energy. We like Shell. We're in Petrobras at the moment, so we're getting a bit of Brazil exposure there, and a couple of other assets. We've got some gold in there. We think gold is another interesting asset class to be thinking about quite carefully here if we are going into a weak dollar cycle. Gold generally tends to really love those weak dollar cycles. And then on the local side, we also got a few names. And then this component would be kind of giving you that pure diversification and pure exposure to offshore and offshore business models that you can't access in South Africa. And we've got some rand hedges, and we've also got some direct offshore exposure as well. And I think the key point to make is you probably don't recognize a lot of those names. And I think that's a really good thing. Because I think when you look at a lot of fund managers out there, they all own the same stocks. Okay, maybe in slightly different weightings. So what we're doing here is we're giving you something quite different that you can put into a solution alongside other managers or a passive index, both globally and locally. And I think you get quite a nice diversified outcome as a result. Okay, so you bring it all together. I think we're trying to diversify, we're trying to balance it, but we're also tactically leaning into this opportunity that we're finding in South Africa as well. And it served us well to do so in the past, and we're confident over the next couple of years, we think that'll bear fruit as well. Okay, so just to leave you with a couple of thoughts, is how does one balance these risks? So if you do agree with me, if I've convinced you at all that South African assets are worth at least having some. So if you got none, at least have some. If you got very little, consider having a bit more. How would one do that confidently? And we've given you a couple of thoughts here to consider. So the first one is absolutely diversify globally. This is non-negotiable. We are a bit of an irrelevant country at the southern tip of Africa. You have to have a global perspective. You have to have global assets. And I think our opinion is that having an integrated approach, you get really good outcomes. You can build better portfolios with better risk management than if you're just lumping silos together and hoping for the best. So regardless of how you want to do it, diversifying globally is the important point that I want to make. The other one is, I think, be selective. We think in South Africa and globally, active stock picking is key. Now, active managers have had a tough 10 years. It's been really hard to beat these indices, which have been powering on by a reasonably few number of shares. But we think, especially if you look into South Africa as a good example, it's really like the stocks that you avoid often add more value than the stocks that you buy. And I think having an active manager that does that for you, we'd be very cautious about buying passive in SA. Passive indices in SA are just so concentrated, and they're dominated by companies that have got nothing to do with SA anyway. So you're not really getting SA exposure by buying passive in SA. So we think active stock picking is the way to go. And then the other thing to say is make sure that your manager has enough breadth. Okay, the big managers, as great as they are and as great as their historical track records have been, by the way, it was when they were smaller, okay, they just got a narrow opportunity set. So yes, maybe they choose the top 20 and they get it exactly right and they do it over and over and over again, but just it gets incredibly hard to do. If you have a wide opportunity set, 100, 150 companies or so on the JSE, you got a lot more options and you can diversify much better and you're actually carrying a lot less risk. And then finally, seek true diversification. Allied to the earlier point, a lot of funds actually look the same. When we look into it, we look at, we're quite concerned that there's a lot of crowding into the same ideas, the same securities. Often it's because they're the same size, and that's really the only things that people can own. We think it's very important and very beneficial to make sure that you have differentiated managers that can play different roles in your portfolio. And there's a lot of good options out there. It's not only us, but we do think we've got a good role to play there. The final point to leave you is this, is that risk management is crucial. But risk is not only about the downside. Investors and clients in this inflationary world and uncertain world need returns, okay? And the opportunity cost of being too cautious is also quite a risk. It's quite a big thing. So what we would say is just make sure we have a balanced approach, think about the downside, take sensible steps to achieve that, but also beware the opportunity cost. There's a big opportunity here when things look this cold and unattractive. And we are certainly looking to take advantage of that for our clients. So thank you for listening. I hope you found some of that useful or interesting. And have a great weekend.